Silver just hit 65, and it changes how this market behaves from here. Not because 65 is magic, but because when a market breaks into a new price regime, it does two things at the same time. It rewrites psychology, and it rewrites incentives. And when psychology and incentives shift together, you do not get the same silver you used to know. You get a faster, more sensitive, more reflexive version of silver. If you have been around this metal for a while, you already know the reputation. Silver runs, then subvertises, then punishes. Silver makes you feel early, then makes you feel late. Silver is the metal that turns good ideas into bad execution. So when silver prints a level like this, the question is not just why did it rise? The real question is what breaks in the old playbook when it does. By the end of this episode, you will know what 65 actually changes, how to tell a new base from a blow-off, and which 3 dials will tell you what is real before the crowd starts narrating it for you. If you want calm, mechanism-based analysis like this, subscribe. This channel is built for long-form investigations, not slogans. And share this with a friend who thinks silver only moves because of noise. Because this is the episode that explains why a generational move can happen even when nobody can agree on a single headline. Now let us start with the moment the market changed. Picture the old range like a ceiling made of cheap drywall. Price hits it, backs off, hits it again, backs off. Months go by and the ceiling becomes a belief. Traders start treating it like gravity. Investors start treating it like disappointment. The market learns a rhythm. And when a market learns a rhythm, it becomes complacent. Then one day, the ceiling does not hold. The first break never looks clean. It looks messy. It looks like a false start. It looks like the market is overreacting. It looks like a candle that will be erased tomorrow. And then the next day, it is not erased. Then the next week, it is not erased. Then the market does what markets always do when a ceiling breaks. It turns the old ceiling into a new floor and it dares you to bet against it. That is what a new regime feels like. Not a celebration, a dare. And the reason this matters is because silver is a small market with a big emotion engine. When silver enters a new regime, flows matter more, leverage matters more. And the gap between paper behavior and physical behavior becomes more consequential. So what actually happened here in the simplest language? Multiple forces stacked on top of each other, not one lever, a stack. A stack is important because stacks do not vanish when a headline fades. A single headline can fade. A stack becomes a background physics problem for the market. Think of it like this. A single gust of wind can move a branch. A storm moves the tree. Silver did not move like a branch. It moved like the tree was being tested. So let us build the stack. First layer is investment attention. When investors decide to care about silver, the metal reacts disproportionately because it is smaller and thinner than it feels. The same dollar that would barely move a deeper market can move silver hard. And when a move begins, silver's reputation does something strange. It attracts the exact kind of attention that makes it unstable. Momentum attention is not about fundamentals. It is about what is happening now. It is about being first. It is about not being left behind. That attention brings flows. Flows bring volatility. Volatility brings risk controls. Risk controls bring liquidation waves. Liquidation waves bring violent pullbacks that terrify newcomers. Then the newcomers sell to the professionals. Then the cycle repeats. This is why a silver breakout is never just a breakout. It is an invitation to chaos. Second layer is the macro environment. Silver is not a pure industrial metal and not a pure monetary metal. It is a hybrid. That hybrid identity is why it can explode when conditions align and collapse, when conditions tighten. When real rates, currency dynamics, and risk appetite shift, silver feels it twice. Once through the monetary lens and once through the growth lens. It is like a microphone placed too close to a speaker. The feedback can be beautiful or ugly, but it is always loud. Third layer is industrial pull. Solar, electrification grid upgrades, the relentless expansion of electronics, the quiet build-out of power infrastructure. None of these are new to you if you have been watching this series. But what matters is not whether they exist. What matters is whether they are becoming more inelastic. Means buyers cannot easily reduce demand without breaking a supply chain. Inelastic means the buyer pays because redesign costs more than the input. When industrial demand becomes more inelastic, it changes the floor under the market. Not every day, not in a straight line, but in the moments that matter, when the system tightens and deliverability becomes the real price. Fourth layer is the deficit narrative. And here we have to be precise. A deficit on a slide does not move markets by itself. Markets can ignore deficits for years if inventories and deliverability feel comfortable. A deficit becomes market moving when it translates into tightness. You can feel tightness in premiums, tightness in delivery times, tightness in the cost of borrowing and sourcing, tightness that refuses to normalize. In other words, the deficit matters when it becomes a plumbing problem, not a talking point. Fifth layer is policy and strategic framing. When institutions start treating a metal as strategic, it does not automatically create new demand overnight, but it changes behavior. Behavior changes procurement, Procurement changes buffers. Buffers shrink the free pool of metal. Shrinking the free pool changes the price of immediacy. And when immediacy becomes expensive, the market becomes sensitive. So the stack is not a story you argue about in a comment section. The stack is a set of forces that can coexist without any single force being the whole explanation. Now, here is the twist that most people miss. The fact that Sylvie reached 65 is not just a result of the stack. It becomes part of the stack because price changes incentives. This is the most important part of the episode, and it is where silver becomes a different animal. When silver is cheap, the world treats it casually. When silver is expensive, the world reacts, and the world reacts in three predictable ways. 1. Producers and recyclers wake up. High prices wake up scrap flows. High prices make it worthwhile to recover silver that used to be ignored. High prices make recycling projects more attractive. High prices make byproduct recovery more aggressive. None of that happens instantly, but it begins. 2. Manufacturers get ruthless. If you're a manufacturer using silver, a high price is not a reason to panic. It is a reason to optimize. It triggers thrifting. It triggers substitution where possible. It triggers engineering pressure to reduce grams and milligrams. It triggers a quiet war on silver intensity. This is why high silver prices can contain the seeds of their own demand destruction over time. 3. The financial market changes how it treats the metal. At lower prices, silver can be ignored or treated like a curiosity. Achi high prices silver becomes a headline. Headlines attract participation. Participation increases volatility. Volatility increases margin requirements. Higher margin requirements force weaker hands out. That is why silver often becomes more violent after it becomes more popular. So 65 is not just a milestone. It is a regime shift because it forces all three reaction channels to intensify at once. Recycling tries to rise. Thrifting tries to accelerate. Speculation tries to amplify. And these forces fight each other in the open. That is why the next phase of silver is rarely a straight continuation. It is a Beto. Now, let us talk about the thing that changes most after a breakout like this. The market's relationship with time. In a normal range market, time is your friend. You can wait. You can average. You can be patient because the market is not in a hurry to reprice itself. In a breakout regime, time becomes expensive. When a market is repricing, it does not wait for you to finish your sentence. It moves in bursts. It gaps. It squeezes. It flushes. It makes you feel like you missed it. Then it makes you feel like you should never have chased it. This is why silver is famous for turning viewers into emotional traders. So let us slow it back down and make it actionable. When a market hits a new regime level, there are only three broad paths that can happen next. Path 1 is the new base. Price pulls back, but it does not collapse. It consolidates at a higher level. The market digests, then builds. In this path, the most important clue is that physical tightness signals do not disappear. The price of immediacy remains stubborn even when the excitement fades. The system stays tight enough that dips get absorbed. Path 2 is the blow off. Price overshoots, then collapses hard. This path is often driven by leverage. Too many participants chase the same move. The market becomes fragile. Then one trigger hits, margins rise, liquidity fades, and forced selling feeds on itself. In this path, you often see the narrative stay bullish while the price is falling because the crowd cannot accept that the move was too hot. Blow-offs are emotionally confusing, which is why they trap people. Path 3 is the second leg. Price pulls back violently, flushes leverage, then tightness returns, and the market resumes the This path is the most common in silver when the underlying pressure is real. Silver does not reward smooth conviction. It demands you survive the purge. Now, here is the key. You do not choose which path is coming by believing harder. You choose by watching the dials. And the dials are not mystical. They are practical. Dial 1 is immediate. Are premiums, lead times, and tightness signals staying stubborn after the excitement fades. If immediacy stays expensive, the system is still tight. If immediacy normalizes quickly, the move may have been more paper than physical. Dial 2 is leverage. Does volatility stay elevated, and do liquidation waves keep resetting the market? Silver in a new regime often needs repeated purges. If the market remains structurally volatile, it is telling you participation is still crowded and fragile. Dial 3 is procurement and policy behavior. Do you see secure supply language? Do you see longer contracts? Do you see industrial behavior that suggests buyers are not just watching the chart, but planning around the metal? When procurement gets serious, it creates stickiness. When procurement stays casual, the market stays mostly sentiment-driven. Now, before we go deeper, I want you to hear one sentence that will keep you sane. In a new regime, silver can be fundamentally stronger and still be psychologically brutal. That is not a contradiction. That is the nature of this metal. So if your strategy relies on being emotionally comfortable, silver will break it. If your strategy relies on understanding the system, silver becomes manageable. Now let us go one layer deeper into why 65 changes behavior in a way most people do not realize. At certain price levels, Silver stops being treated like a cheap optional hedge and starts being treated like a meaningful budget item. When silver is cheap, industrial users can absorb price moves without changing behavior. When silver is expensive, the same users get pressure from finance departments. Cost becomes a meeting becomes a project becomes an engineering mandate. An engineering mandate becomes thrifting and substitution, so higher price accelerates the forces that will try to cap demand growth over time. At the same time, higher price also makes investors and institutions treat silver like a real asset again that can increase the flow channel in the short and medium term, even as the industrial channel tries to optimize down. This is why the new regime is a tug of war. Industry tries to escape the silver tax. Investors try to ride the silver repricing. Recyclers try to harvest the silver spread, and the market becomes a battlefield where price is the score and volatility is the weapon. Now, here is the most important point of the entire episode, and it is the point most people ignore because it is not exciting. The next move in silver will be decided by the price of immediacy, not by the loudest narrative. The loudest narrative is always late. It arrives after the move. Immediacy is early. It shows you whether the system is tight before the chart looks dramatic. So if you want to understand whether 65 is a new base, a blow-off, or the middle of something bigger, you do not start by guessing. You start by watching whether the system is still charging rent for certainty. And that brings us to the final question of this first chunk, the question we must answer next. If silver is in a new regime, what does the next year actually look like in practice? Is the market building a higher floor, or is it preparing a violent mean reversion, or is it winding up for another leg that will surprise everyone who thinks this was the end? Because the truth is, in silver, the breakout is never the ending. It is the beginning of the hard part. It is the beginning of the hard part. Because once a market breaks into a new regime, it starts testing everyone who showed up late, and it starts testing everyone who thinks the old rules still apply. The first test is the pullback. Every breakout invites a pullback, because the market has to find out who is real and who is borrowed. Who bought because they understand the system, and who bought because they could not stand watching the chart move without them. Silver is especially ruthless here because it is thin, emotional, and easy to leva. So the first thing you should expect is not a victory lap. You should expect a fight between momentum and mean reversion, a fight between physical tightness and paper liquidation, a fight between people who want a clean trend and a market that refuses to give you one. Now, if you only remember one discipline from this episode, remember this. Do not use the spot chart to decide whether the regime is real. Use the price of immediacy, because in silver, the spot chart is the theater poster. The price of immediacy is the line at the door. In a regime shift, the poster can change every day. The line at the door tells you whether the system is actually tight. So what does the next year look like in practice? Let us walk through the three paths again, but this time we turn them into something you can recognize in real life. First path is the new base. In a new base, price pulls back, sometimes sharply, but it does not lose the structural level that the market just fought to reach. It consolidates, it becomes boring again, but at a higher altitude. And the tell is not whether it is boring. The tell is whether the system keeps charging for certainty. In a new base, physical tightness signals stay stubborn. Premiums stay elevated in a way that does not fully normalize. Delivery terms do not suddenly become easy again. The market continues to show small dislocations that close slowly because the system is still less flexible than it used to be. Volatility stays elevated, but it becomes more organized, more rhythmic, less like a single parabolic climax and more like a sequence of pushes and resets. A new base feels like the market inhaling, preparing for the next move, while refusing to give back the ground it just took. Second path is the blowoff. A blowoff is when the market runs so hard on attention and leverage that it becomes unstable, then collapses under its own weight. The tell here is that the chart goes vertical, and the story becomes absolute. People stop asking questions and start issuing commandments. This is when everyone becomes certain that the move must continue, and that certainty itself becomes the signal that fragility is rising. In a blowoff, you often see the paper market dominate the tape, volatility spikes, margin requirements rise, liquidity thins, one trigger hits. Sometimes nothing more dramatic than a shift in risk appetite, and then the forced selling begins. When forced selling begins, silver does what silver always does. It moves like a trapdoor. A blowoff can erase weeks of gains in days. And here is the part that confuses people. A blowoff does not automatically mean the long-term story is dead. A blowoff means the path was too fast and too crowded. But if the blowoff is truly just paper, you will often see the physical tightness fade as well. Premiums cool, delivery terms ease, the price of immediacy relaxes. That is the market telling you the breakout was largely speculative. If physical tightness does not fade, you might have a different path. Which brings us to the third path. The second leg. This is the most silver path, and it is the path that breaks the most people because it feels cruel. In a second leg path, the market runs, then it violently flushes the late leverage, then it stabilizes, then it resumes the repricing. It is not smooth, it is not fair. It is a lesson in survival. The tell here is that the pullback is violent, but the system refuses to become loose. Immediacy stays expensive, premiums remain stubborn, dislocations reappear quickly after they fade, the market behaves like it is tight underneath even as the paper price is whipping. This is when you get the psychological split. One group screams that the move is over because the chart is falling. Another group sees the physical and says the system is still constrained. And then one day the market resumes. And the people who are watching only the chart feel like the rally came out of nowhere. It did not come out of nowhere. It came out of the plumbing. Now, we need to do something important here, because without it, this episode would be incomplete. We need to explain why silver feels different above a level like 65 in a way that is not mystical. It is about who is forced to act. When silver moves into a new regime, certain participants cannot stay neutral. Industrial users feel it. If you are using silver as an input, you now have to answer questions you could ignore before. Can we keep absorbing this? Can we reduce intensity faster? Can we qualify alternatives? Can we lock contracts to reduce volatility exposure? Can we secure supply for the next cycle? That creates the first new behavior shift. It accelerates thrifting and substitution pressure. At the same time, the same high price creates a new behavior shift in the supply chain. Recycling becomes more attractive. Scrap flows increase. Recovery projects make more economic sense. Byproduct recovery gets more attention. Again, none of this happens instantly, but the direction matters. The system begins trying to respond. And then you have the third behavior shift. The investment and speculative ecosystem changes. At lower prices, silver is easy to ignore and easy to keep underweighted. At high prices in a breakout regime, silver becomes a headline asset again. It enters watch lists, it enters portfolios, it enters conversations. That attention increases participation, and increased participation increases instability, because silver is not as deep as the attention thinks it is. So the new regime is a three-way fight. Industry tries to reduce dependence. Supply tries to increase responsiveness. Investors try to ride the all three are true at once. That is why it feels chaotic. Now, let us bring the viewer back to what matters, because the human brain loves drama and hates monitoring. If you want to survive this regime, you need to treat silver like a system. And that means you need a process. Here is the simplest process that actually works. First, stop asking what the price should be. Start asking whether the market is loose or tight. Loose or tight is not a vibe. Loose means immediacy is cheap. Tight means immediacy is expensive. So you monitor the price of immediacy premiums, delivery terms, lead times, borrow costs, and sourcing friction when they matter. Second, monitor leverage conditions, not because you want to predict liquidation, but because you want to understand fragility. High volatility and crowded positioning create a market that can drop hard even if the story remains intact. Third, monitor procurement and policy footprints, not speeches, footprints, long-term agreements, secure supply language, industrial behavior that suggests this is being treated as a strategic input, not a casual purchase. Now, here is the part where most people accidentally sabotage themselves. They treat regime analysis like a one-time decision. They decide once, bullish or bearish, and then they act as if the market must obey. That is not how silver works. Silver is episodic. Silver delivers the story in bursts. So you do not marry a forecast, you marry the dials. If the dials remain tight, the system is still constrained, even if the chart is violent. If the dials loosen, the system is relaxing, even if the chart is still exciting. That is how you avoid being late. Now let me give you one more mental model, because it makes the new regime feel obvious. In the old regime, silver was a trade you timed. In the new regime, silver becomes a system you monitor. A trade you time means you focus on entries and exits like you are trying to catch a bus. A system you monitor means you focus on whether the underlying conditions are tightening or loosening, and you accept that the bus will sometimes slam the brakes and sometimes accelerate without warning. This is why you cannot judge the regime by 1 week of price action. You judge it by whether the system keeps charging rent for certainty. Now, we should confront the strongest counter case again, but this time we make it practical. The strongest counter case is that this move could still mean revert hard, that silver could have overshot on attention and leverage, that the economy could slow, that industrial demand could soften, that substitution and thrifting could accelerate, that recycling could rise faster than expected, that the market could spend a long time digesting this move, or even retracing it before any new leg appears. That counter case is real, which is why the only honest stance is conditional. If tightness signals fade, the regime weakens. If tightness signals persist, the regime strengthens. If leverage stays extreme, volatility stays brutal. If leverage resets, the market becomes more stable. You do not need certainty. You need a dashboard. Now, because you are watching this as a viewer, there is one more thing you deserve. A clean way to explain what 65 changes in one sentence. 65 changes silver by forcing the entire ecosystem to react at the same time. And when the ecosystem reacts together, The market stops behaving like a sleepy range and starts behaving like a stress asset. That is it. Now, before we close, do me a favor. If this episode helped you understand silver as a system instead of a mood, subscribe, because the next episodes will keep building this map with clarity and without panic. And share this with a friend who thinks silver is only a story about one catalyst. Because silver is rarely one thing. It is usually a stack, and the stack is what creates the violent surprises. Now, we end with the final synthesis, the one that ties the entire regime together. Silver at 65 is not a guarantee of a straight line higher. It is a declaration that the old ceiling has been challenged, and that the market is now in the phase where it tests every assumption you built in the old range. It will test patience. It will test leverage. It will test conviction. It will test your ability to watch the right variables instead of the loudest headlines. If the price of immediacy stays stubborn, the system is still tight. If the price of immediacy relaxes, the system is loosening. If volatility stays extreme, leverage is still crowded. If volatility resets, the market is becoming healthier. This is how you read the next year without pretending you can predict it. You monitor the system because silver did not just rise, it changed its role. From a trade you time to a system you monitor. And in this new regime, the people who survive are not the ones with the loudest prediction. They are the ones who watch the plumbing and act before the crowd realizes the rules have changed.